Let's do a quick comparison between the E-mini S&P 500 future and the SPY Spider. I do want to remind everybody that trading futures, options, and futures involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. All right, let's do a case study between these two instruments. So let's take a look at the opening range on October 9th from 8:30 in the morning to 9 o'clock Chicago time. On the left-hand side, we see the E-mini S&P, and during that 30-minute range, we had a high of 29.18 and a half and a low price of 29.07 and a quarter for a difference of 11.25. On the SPY side, we had a high of 291 and a quarter, a low of 290.14 for a difference of $1.11. And you can see that these prices are very, very similar. They track the same benchmark S&P 500 stock index. The decimal points difference simply due to the math of the two instruments. Let's take a look at the difference between the difference of the range and the ES. Each point is worth $50. That's the multiplier for an E-mini S&P due to its leverage, and you have 11.25 times 50 is going to give a dollar value of $562.50 for that entire range. So if you would have bought the low with one contract and sold the high, you would have made $562. If you would have bought the high and sold the low, you would have lost $562.50. On the SPY side, the difference is simply $1.11 times $1 per point equals $1.11 for the same range if you were to buy a share. Let's assume we have an $8,000 account to start our process and compare the two. So on the one hand side, as we already discussed, one E-mini contract, you could buy one E-mini contract with an $8,000 account based on exchange minimum margins, and that price difference was, again, $562.50. For the SPY, you'd be able to buy 27 shares of SPY, and the difference would have been $1.11 times 27, or $29.97. Alternatively, if you ramped up your leverage to 2 to 1, which you could do with the SPY, you could do 54 shares, and you would do $1.11 times 54 to give you a dollar value of that range of $59.94. Now, when you apply futures trading, day trading leverage, everything gets different. Everything is magnified. So in our initial example, we had one contract of E-mini S&P at $562.50 for the range, and that was the maximum range. No day trade margin applied. If you were going to apply a $4,000 day trade margin, your broker let you do a $4,000 day trade margin, then you'd be able to do two contracts of the ES. 2 times 4,000 equals 8,000, and that would have either made you or lost you $1,125. Or $2,000 day trade margin, you would have had 4 contracts, so 4 times 562.50 is 2250. $1,000 day trade margin, you would have had 8 contracts max for $4,500 for the range, and then a $500 day trade margin you've been able to do 16 contracts for a $9,000 range. Of course, we wouldn't recommend this extreme amount of leverage, but that flexibility is afforded to you at Infinity Futures, and this is the power of leverage. And again, remember, leverage is a double-edged sword, right? It could work for you as well as against you. It magnifies gains as well as magnifies losses. If you wanted more information on trading futures ES versus the SPY or any other futures contract for that matter, please contact us directly at 312-373-6220 or go to our website, infinityfutures.com. Email us at trade@infinityfutures.com. Hope that helps.